Welcome back, folks. Liberty Call for Thursday, April 21st, 2021. I hope everybody's having a great day out there. Pardon any noise you might hear in the background. I'm having some construction done, like I mentioned yesterday. Or not construction, they're ripping out the old furnace and putting in a new one and a new water treatment system. So it's going to be really great once it's all done. Would be nice to have some hot water to take a shower. As you can tell, my beard's a little messy today. So, all right, well, let's go ahead and dive into the markets. They had a pretty bad day, as you can see here. It started out really well. This is the Dow Jones. You can see it was up about 300 points early in the morning, and then it just started to slide. And then about 1 p.m. Eastern time, dropped into the red and finished down the day. The day finished down about 372 points. So you can see from peak to bottom. I mean, it was down almost 750 points from the very top to where it bottomed out and finished a little bit higher than where we started. So not the best, but these things do happen. So, all right, well, let's go ahead and check out the rest of the indexes. As I said, the Dow Jones was down. It finished down 1.05% today at 34,792. S&P 500 was down 1.44%, closing at 43.95. The NASDAQ was down 2.07%, closing at 13,174. Small caps were down 2.3%. The VIX was up 12.35% today. It's at 2283. Still not too high that I'd get too antsy about, but again, the longer term picture, I do see things are probably going to trend in a negative direction. The other exchanges here in the Americas, Canada was down 1.5%. Brazil was down 0.62. Mexico was down 1%. Moving over to Western Europe, Germany was up 0.98. The UK was flat at down 0.02. France up 1.36. The euro up 0.8. See, is this the Netherlands? Yeah, Netherlands was up 0.47. Spain was up 0.5% at 0.51. Let's see, here's this. Italy was down a quarter of a percent. Switzerland was down 0.07. Portugal was down 1.11. Belgium up 0.2. And let's see, Austria was up 1.17. Moving further down to Eastern Europe, the Russian indexes were split. The MOEX was down 2.56. The RTSI was up 0.11. Let's see here. Mostly greens here in Eastern Europe. We had greens in Hungary, Turkey, Israel. Saudi Arabia was down 1%. Japan was up 1.23. Australia up 0.33%, and New Zealand down 0.61. Looks like all the Chinese index or exchanges were in the red. The Shanghai was down 2.26. The SESE component was down 2.7. The China A50 down 1.14. DJ Shanghai down 2.34. And the Hang Seng down 1.25. And the Taiwan weighted closed down 0.12. So mixed day. So, all in all, the Asian markets took a beating. And here in the U.S., it looks like we got beat up pretty good. Looks like Western Europe and Eastern Europe did fairly well, all things considered. So certainly not the worst day, but, things could be better. Again, it kind of feels like back in 2007 and 8, where you could tell things were headed in a bad direction, but not much you can really do about it, especially when you have idiots in Washington who keep screwing shit up. All right. Let's read this market recap here. S&P 500 slides as bearish bets on tech resume after Powell tees up 50 basis point hike. The S&P 500 stumbled Thursday as tech returned to the firing line after Federal Reserve Chairman Jerome Powell teed up the prospect of a 50 basis point hike at May's meeting. Quote, I would say 50 basis points will be on the table for the May meeting, Powell said in an IMF panel discussion on Thursday. The Fed chairman didn't shy away from hinting at the central bank could hike aggressively at the start of the tightening cycle by front-loading 50 basis point hikes at future meetings. That'd be a good thing. U.S. Treasury yields were quick to respond, with the 10-year Treasury yield rising close to 3%, pushing growth corners of the market, including tech, lower. Meta, formerly Facebook, led the decline, in big tech falling 6%, while Google, parent Alphabet, Amazon, Microsoft, and Apple were also in the red. Netflix, which posted its biggest one-day decline since 2004 on Wednesday, fell more than 3%. Famed investor Bill Ackman, who bought the dip in Netflix in January, said his hedge fund Pershing Square has exited its position at a loss. Tesla proved the exception to the broader market sell-off after the electric vehicle company reported quarterly results that beat analysts' expectations on both the top and bottom lines, despite the supply chain and input cost pressures. Quote, the Cinderella-like numbers and good guidance in a brutal supply chain backdrop speaks to an EV demand trajectory that looks quite robust for Tesla throughout 2022 with a massive 2H ahead. I'm not sure what 2H stands for. Maybe second quarter? I don't know. Airline stocks racked up gains as stronger than expected results from United Airlines and American Airlines stoked optimism about a pickup in travel demand. Quote, while what stood out from the United Airlines earnings release was the record revenue guide for the June quarter. Deutsche Bank said in a note, quote, furthermore, the company reiterated full year probability for 2022. AT&T, meanwhile, was also in the ascendancy after telecom giant reported first quarter results that topped Wall Street estimates. Energy also dragged the broader market lower, falling more than 2%, weighed down by weakness in Baker Hughes and Devon Energy companies. So again, it looks like tech's getting pummeled other than Tesla, but so again, we'll see where the longer term trends continue to go. Wall Street sinks, bond yields up as Powell suggests aggressive Fed policy. This has to do with what the Fed's planning on doing. Wall Street reversed course and turned negative on Thursday, and bond yields surged as Federal Reserve Chairman Jerome Powell suggested the U.S. central bank could move more aggressively to curb inflation. Powell said that a half-point interest rate increase will be, quote, on the table when the Fed meets in May, adding it would be appropriate to, quote, be moving a little more quickly, end quote. U.S. stocks opened strong, buoyed by corporate earnings and strong jobless data, but began to retreat ahead of Powell's afternoon remarks as investor concerns about central banks' inflation fight took center stage. Quote, Powell is intimating that avoiding a recession will not be easy. that is new, said Tim Gursky, senior portfolio strategist at Ingalls & Schneider in New York. Quote, it's a relief for the market to hear the Fed admit this. Therefore, they may be more focused on avoiding this possibility or avoiding any type of deep recession, which is what the market really fears, end quote. Bond yields were on the upswing Thursday with the benchmark 10-year Treasury yield climbing 2.9347% after Wednesday's high of 2.981%, which had been the highest since December of 2018. Markets had also been boosted in the day as upbeat Tesla earned. Oh, yeah, we already covered all that. Powell said in a discussion of the global economy at the meetings of the International Monetary Fund that the labor market was not sustainably hot. His remarks effectively confirm market expectations of at least another half percentage point rate hike from the Fed next month, while one ECB policymaker said on Wednesday it might start hiking Eurozone rates as early as July. Citi's global global market strategist Matt King said the pressure for the markets was also coming from quantitative tightening, or QT, the process of years of frantic central bank money printing going into reverse. That process is just about to start, and over the next year, he estimates we will see around $500 billion being sucked out of the global financial system by the Fed alone. So we'll see if the Fed actually sticks with what they say they're going to do. I don't have a lot of confidence in them, unfortunately. One second. Lemonade, good stuff. But so like I said, my biggest fear is that the Fed is going to turn tail as soon as they hit any sort of turbulence or roadblocks or anything like that. So we'll see what happens. All right, some good news out of the economic numbers. U.S. jobless claims held steady at 184,000 last week, but Philly Fed plunges. The number of people filing initial claims for jobless benefits held steady last week, reflecting a labor market that remains tight as a drum, increasing signs of a slowdown on the horizon due to surging inflation. Initial jobless claims inched down to 184,000 from an upwardly revised 186,000 the week before, but remain close to the 60-year low they posted at the start of the month. Initial claims have now been clearly below 200,000 a week for the last 4 weeks. Continuing claims, meanwhile, fell by more than expected to 1.417 million from 1.475 million a week earlier. Tightness in the labor market also reflected in strong average earnings growth in recent months, one of the main factors weighing on the Federal Reserve's mind as it prepares to raise interest rates again at its next at its meeting next month. San Francisco Fed President Mary Daly on Wednesday highlighted the frothy conditions as regards to hiring as one of the key reasons why she thinks the case for a 50 basis point hike in the Fed funds rate in May is both solid and complete. Inflationary pressures were in evidence elsewhere on Thursday as the Philadelphia Federal Reserve released its monthly manufacturing survey. Prices paid component in the survey's main index activity rose to a new 43-year high of 84.6. The overall index fell by more than expected to 17.6 from 27.4 in March, as more business took a dim view of future conditions. Capital spending plans and new orders also fell sharply. The Phillies Fed survey tends to have more forward-looking elements to it than the weekly jobless claims numbers. Labor market data are in most cases seen as a lagging indicator of economic trends. So, like I said, some good news. The labor market does appear to still be fairly strong. But again, all the actions over the last few years have really painted us into a corner where we're really screwed at this point. So, don't be shocked when, the economy slows down and the markets recede due to that fact. So it's just it's a cycle we have to go through, and we postponed it for years by keeping interest rates at or near zero, through, the Obama years and the Trump years. When the Trump administration did try to raise rates back in, I think it was 2018 and 19, the market threw a damn temper tantrum, or they called it a taper tantrum. And, rates went right back down. And then we had Corona, and we went back to printing money and zero interest rates really fast. So anyways, all right. Well, that's everything I had for today. So if anyone needs anything from me, don't hesitate to reach out. You can reach me at dsafinancialgroup.com. All my contact information is there. You can send me an email, drop me a phone call, schedule a meeting, whatever you'd like to do. All right. Well, that's everything, like I said, that I had. Hope everybody has a great night, and I'll be back tomorrow with the weekly wrap up. So have a great evening, folks. Bye-bye.